Kraftig eufori på Wall Street igår fortsatte i Asien och i Europa. Stockholmsbörsen fortsätter upp rejält inför öppningen på Wall Street. Idag har vi med oss två gäster, Kevin O'Dowd och Julian Brigden, both with MI2 macro research firm and both old friends of EFN, of course. We talked just a couple of weeks ago about a rather gloomy outlook. Kevin, it's been a terrifically challenging couple of days in the market. What are your thoughts on yesterday?
Well, good afternoon, Gabriel. I think yesterday, Wall Street breathed a sigh of relief. You had the Trump administration announcing a significant rollback to tariffs to blanket 10% for all non-retaliating countries, excluding China. It was a pivotal shift, I think, that injected a lot of short-term confidence into the markets, leading to a historic rally with the S&P and NASDAQ up 10 and 13% respectively. Why the dramatic turn? I think it's largely due to the bond market reacting sharply to the 10-year yield spiking 65 basis points in just a few days. I think signaling breaks in the market. The White House came in timely intervention. I think it appears to be a direct response to those warning signs. Our market predictions pretty much on target, forecasting this sizable counter trend rally. This isn't just luck. It's about strategically reading the market signals and timing our moves accordingly. However, let's temper our enthusiasm with a dose of historical perspective. The largest single day rallies often occur in these bear markets. For instance, during 08, despite several large one-day gains, the market ultimately ended up 28% lower. And I think this pattern suggests that while significant rallies can provide short-term opportunities, they don't necessarily signal an end to these bearish conditions. I think the tariff relief is a temporary 90-day reprieve. You've got major trade tensions still unresolved, particularly with China. This is just a temporary stabilization period. When you look ahead, the S&P has pushed through some key resistance levels, but I think faces further challenges. The same goes for the NASDAQ and European markets well. I mean, yesterday's rally is approaching significant resistance that I think will slow its ascent. Market volatility, VIX saw its single biggest day drop in history, which suggests a reduction in market stress. However, I don't expect volatility to go completely away. In summary, while yesterday marked a significant recovery, we're watching closely for follow-through, see how the situation develops, particularly with upcoming earnings reports and continuing tariff discussions. And from there, I should probably give it over to you and Julian for a bit.
I want to hear Julian's thoughts too. When I see the stock market pop 10 or 13% in one day, it makes me scared rather than assured. Your thoughts on yesterday's reaction, and what do you expect of today's trading, Julian?
So good afternoon, Gabriel. Look, I think to Kevin's point, some response was absolutely necessary. I mean, I've been in this market almost 40 years. I've seen a handful of occasions that looked like yesterday and the day before. In other words, we were moving, Gabriel, into what we used to call, in one of my early jobs in the business, the sell the US moment. So in other words, investors were selling bonds, treasuries, they were selling US stocks, and they were selling the dollar. So in other words, this sort of wholesale liquidation, fire sale kind of situation. And in those half a dozen occasions that I've seen that in almost 40 years, policymakers have always had to respond. Always had to respond, because you just can't have that sort of cascading situation. So I think,
but they did. Just that it was the White House, not the Federal Reserve.
Correct, sir. This time it was the White House. I think probably led by Scott Bessent, who I think is a very stable set of hands, and I clearly understands these markets from his time working on Wall Street for various hedge funds, and I think that's, as Kevin said, that's given us a pause for breath. I think we have to ask, has it really materially changed anything? And I think the answer is no, unfortunately. I mean, I think we're still looking at a situation where we're going to get a very significant rise in tariffs. Let's assume where we are. I think the Trump administration thinks that China's going to bow. I'm not sure that is. That leaves a sort of aggregate tariff rate at somewhere between 25 and 30% in the US. They still want to upend or change, let's say, the rules of global trade that we've been enjoying since the late 1980s. They want a materially weaker dollar. And I think that's going to come out in these trade discussions, which are going to start in Asia with the Japanese and the Koreans soon. And I think that has as I said to your audience last time, if you start to change the direction of the dollar, it is probably the most important thing when it comes to asset allocation that sets the trends and the trades that you do for the next five years.
I want to talk more about this shift, this fundamental shift. But since we're in the opening of American trading, I want to listen to both your takes on what do you look for? Are we going to open negatively? Are we opening bad? And does that matter for confidence? Kevin, your thoughts on the very early trading in the US as of right now? We seem to be down a couple of percents on the S&P.
It absolutely matters. I mean, what you're looking, after the close yesterday, what I would have been looking for today was a higher open, higher high, and an up close. And obviously, the lower open today, just right out of the gate, tells me that, we're not going to see any significant follow through, in my opinion. Likewise, I saw Europe open today, gap up. Basically, your opening trade was the high trade for the day. We're not seeing follow through, which to me signals that this was more of a short cover type rally than anything else. So I would not be surprised if ultimately we go back and we retest the lows. I don't think we've completed that down cycle, but we'll see how we close today. But right now, we've hit sort of a brick wall, and this down opening today is not a good sign.
Julian, your thoughts on market short term? So look, Gabriel, I think as Kevin outlaid, this is bad price action, right? You get what they refer to as these bull market squeezes, and this appears to be definitely one of them. I think that I would say there's some important dynamics going on here. So the US retail investor has been relentlessly buying this dip, right? They have been taught after, 15 years that this is what you do because the central banks always come to your aid. I think those conditions have utterly changed, but they have learned this, right? You have memes going around and T-shirts going around, where I never sell. Well, yeah, that's, good, I guess, but it's
diamond hands.
long-term investor.
We call them diamond hands.
Yes,
Sorry.
Exactly. Diamond hands. Exactly. That's absolutely right, Gabriel. But what I think they're running into is foreign real money. So pension money, sovereign money that has been very overweight US stocks in particular, but US assets in general, has done insanely well, right? I mean, if you're a Swedish investor and you've bought S&P unhedged, you were up 200% in 5 years, right?
Not bad.
200% in 5 years, right? Now you just watched in 2 months that dropped 25% off the top, right? You lost 25% of that total 5-year gain. At a bare minimum, Gabriel, some bit of judicious profit taking to lock in some of those returns makes sense. And I think this is what's happening. I think you are going to see every single day that we are going to walk in, and the risk is that the overnight session, where the foreigners are the most active, is weak. Then the US tries to buy it up because those retail investors in the US still believe that this thing is going to work, and they're just going to get crushed by literally trillions of dollars worth of selling.
Speaking of different markets and different actors, Kevin, I want to hear your thoughts on the Stockholm Stock Exchange. Does it matter? It's a volatile one. We know that one. It's full of Swedes, obviously. Does it matter to you?
Look, for me, looking looking at Europe, I have always used Sweden as the canary in the coal mine due to its tech and industrial exposure. It was the first market in Europe to market top of everything that we look at. It was the first to roll over at everything we looked at. It was the first to break down and go through key resistance levels. And when you look at the tape today, the OMX, experienced a very short-term covering rally, but bulls quickly, I think, encountered some strong resistance. The rally stalled right at the critical 38.2 Fibonacci retracement level situated at 2353, which I think marks the span from the February highs to the April lows. And failure to break through that level suggests a potential reversal back to recent lows, indicating, I think, a lot of unresolved market pressures. Additionally, I think when you look at Europe's market response this morning, it's very lackluster, opening near the highs, a sign typically indicative of short covering and an unwind of oversold positions. So I think this suggests that Sweden may be serving as the canary in the coal mine once again, signaling broader European market vulnerabilities. And I think ultimately, we're not done on the downside.
So let's move from the pessimistic short-term view to the pessimistic long-term view, meaning switching from Kevin to Julian, essentially. Julian, we talked about the big seismic shift that we're looking at in changing the position of the dollar and uprooting a little bit the system we've gotten used to when it comes to global trade. Has anything changed? Did Donald Trump, he blinked obviously facing the bond markets, but did he change his mind in a bigger perspective?
No, I don't think so, sir. Not at all. I think, look, as I said at the beginning, Gabriel, I think this is an administration where investors assumed that this current administration would look exactly like Donald Trump's first administration. And I think they just utterly misread the rules. I think there's some reasons for that. I don't think Trump actually, I'm told from my policy friends, got what he wanted in his first term. He wanted a tax cut that was for corporates that was going to be very conditional on those repatriated dollars. He was trying to tackle that pool of amorphous cash that sits offshore in those various banking low tax places like Ireland, to come back in the US and be used to build factories and create jobs. And then the tax package went to Congress, the lobbyists got their sticky little fingers all over it, and everyone got a tax cut. All the conditionality was removed. But there was a very clear objective that if the president had had his way, would have achieved more re-onshoring. This time, I think his approach has been tariffs, much more stick in a way than carrot. And I think he's determined to deliver this, Gabriel. I think people, when you listen, and I think this is one of the things that you need to do with this administration, they tell you what they want to do. When someone like Scott Bessent says, Wall Street, that means the globalists, the 1%ers, the equity holders, have had it very good for a long time. We're not worried about them. We are focused on Main Street. Mm-hmm. That is a very, very clear message. It is a poignant message for investors because it means that the companies that did well in that period of, let's call it post-Reagan, Thatcher, deliberalization of the late 80s, early 90s, may end up being the losers in the new world. Does it help the working American if you crash the stock market? No, it certainly doesn't. But I think they honestly don't think this market will crash. I personally see that as one of the potential vulnerabilities. I don't think they quite realize the fragility of the system. There's a lot of people here who say, we're in a very strong state because the consumer is very strong. The problem that I've got in that is this is somewhat self-reinforcing in the sense that the consumer is very strong because the equity market was very strong. And if the equity market starts to come down, because foreigners, for example, start to take their money out because in Swedish krona terms, right? Because the Swedish krona, as we speak, is trying to break yet again a support line that's sort of held us since 2022, right? And if it breaks here decisively, we're probably going down into the mid eights, so 850, 860, right? that means that you as a Swedish krona investor, if you're in the S&P and you haven't hedged your FX exposure, which most people want, will lose even more money. So I think the danger is that foreigners start to take their money out. Like I said, there's this wave of institutional foreign money. I think now that is a seller, that if you don't get that rebound in the equity market in the US, you'll actually start to expose actually how fragile the consumer potentially is, because we've had some really startling data. I mean, and for a country like Sweden, which is, you know, relatively well balanced in terms of where consumption comes from, we were just told by Moody's a few weeks ago that 48% of total consumption in the US comes from the top 10%. Right?
It's very fascinating and very disturbing, of course.
It's very disturbing because they're very sensitive to their wealth, Gabriel, right? So if the stock market drops 20%, 30% and doesn't rally, the risk is here that that consumer spending will really take a step back, right? So I think there's a lot of inherent potential vulnerability. I applaud the Trump administration in many respects for what they are trying to do, right? Rebuilding the middle class, rebuilding American industry, which we know has been, this offshoring has been a problem, not just in the US, but in Europe, right, as well. Huge problem, right? Huge problem. This gouging out of the middle class, this destruction of high-paying kind of jobs, right? I think the trade deficit is out of control. You cannot spend 4% of GDP every single year importing stuff, right?
But all right, even if I would agree with those premises, has Donald Trump, and I want a brief answer here, has Donald Trump showed an ability to actually do something about it that could bring meaningful positive change? Or has it just been a bit of shooting in the dark, so to say?
No, I think there is. I firmly believe, knowing some of his officials, that there is a plan, in inverted commas. I don't think it's fully perfected, right? They do have to deal with some of the president's eccentricities, but I think there is a plan. But I think they do genuinely believe, Gabriel, that this is not a costless plan. I think the days where we had true costless options are gone. The deficit is too great. The dependence on China is too great, that this can just be an easy choice. There are easy options here.
Kevin, I wanted to fill in on this. Do you see this path as a credible one? Do you think could be a happy outcome from what we've seen so far?
Look, I mean, that's to be determined. I mean, the big question in the rally yesterday, from a short-term perspective, was were we on the brink of collapse in the fixed income markets? Were whispers of political relief that basically sparked the surge? And in Washington, the buzz is about potential market manipulation now. All the critics of President Trump suggest that he may have tipped off investors just before the rally, prompting a lot of these Democrats to call for hearings, to delve into trading and, phone records. If we look ahead, I think the situation remains pretty fluid with a 90-day window with the political landscape could shift dramatically. We'll have to see. Meanwhile, I think you've got rising tensions with Iran, which I think could overshadow a lot of these current market concerns. On the trade front, the ongoing tariff war sees China on the back foot, with many U.S. politicians ramping up their rhetoric against Beijing. Back home, the failure to pass a budget, I think, is going to cast a long shadow over any quick moves or in the markets on tax cuts or, reflecting deeper, I think, in some of these legislative changes. So we've got a lot more on our plate than just tariffs. And I think, in summary, while, yesterday's market action offers a temporary sigh of relief, I think the underlying issues are far from resolved. And I think if you're a trader or a portfolio manager, you have to really stay alert, because I think in the next coming days, it could bring a significant shift in volatility, I think, as a lot of these narratives that we're looking for start to unfold.
short-term volatility in the coming month or so. Julian, could I get a concluding? I mean, this is a big operation. It has potential. Donald Trump is not entirely misguided, but it's a risky path, obviously. Where do you see markets going if we look at the rest of the year, so to say, the medium term?
So I agree with Kevin. I'm not sure that we've necessarily flushed out the risk, certainly in the US market, and the European market, is vulnerable in that type of scenario. I think structurally into any weakness, Gabriel, I would be looking to diversify out of the US, particularly as a European investor or a foreign investor, given the likely losses that you're going to start to take on the currency. And I do really want to stress that, right? The US markets do not perform in a weak dollar environment. And if you look at, say, the euro, and I'm looking at as we speak, we are breaking arguably a 17-year trend line as we speak, right? And in that environment, there are other things that you buy. I mean, I think there are absolutely enormously great opportunities, but it's a mindset change, Gabriel. What we have done since 2008 is just bought the US, bought the US, bought the US. And as I said, just in the last 5 years, investors have done insanely well. So that recency bias, right? Oh, well, I always have to buy US tech stocks, right? No, not when the dollar starts to weaken.
Says Julian Brigden and Kevin O'Dowd with MI2 macro research firm. It's still a bit gloomy, but it's also always a pleasure to have you both on. Don't be a stranger, and we'll talk again soon.
Thank you, Gabriel.
Thank you
Thank you,
both.
Gabriel. Bye-bye.